Good morning. I'm going to do notes number 3 today, which is about the new deflation. Of course, we're no longer in that moment. We don't have a new deflation over that period, but the period is basically the period from 2007, the beginning of the great financial crisis, which is basically March 2007, to the great pandemic and coming out of the pandemic. Right? So we're talking about a period of 14 some years from 2007 to 2021. And this period, remember, what I'm trying to do is I'm trying to understand historical patterns, right? In terms of understanding how capitalism evolves and moves through time. And so I focused on this phenomenon of long waves, right? Kondratiev. And those long waves have technological dimension, they have financial dimension. The technological dimension was Schumpeter, the financial dimension Minsky. But there's also a policy making and institutional dimension, and that gets best captured by the regulationist approach. And within that institutional framework that we can identify as accumulation regimes, so we can look at the long waves in terms of distinct phases of capitalism. Yes. So we have a competitive accumulation regime in the middle of the 19th century. Then we have a monopolistic accumulation regime from the end of the 19th century into World War II. And then we have Fordism, the post-war boom and stagflation crisis of the boom in the 50s, 60s, stagflation crisis, 70s, early 80s. Then we have finance-led capitalism, which is what we're going to talk about today, right? Which starts around 1982 and is about to change now. Okay, we're at the end of this. We're getting at the end of finance-led. That's one of my arguments, right? And that's an argument I will make more strongly today. That we're at the transition from one accumulation regime to another. Right? But these transitions are complicated processes because they require both a deeper type of crisis. Okay. So one of the important things that I identify in this long wave pattern is that you have two different crises. Okay? One at the beginning of the downswing and one at the end of the downswing. So the one that we have in the finance-led capitalism long wave, the beginning is the great financial crisis of 2007, 2008. And the crisis at the end of that long wave, and I'm arguing that that's what's happening right now, sort of what we call a transformative crisis, a crisis that transforms an accumulation regime into something else. That crisis, we're right in, we're beginning, we're already in it, okay? We're in the middle of it, or not in the middle, I don't know temporarily, but it's in the middle, but we're definitely in it. We're in a transformative crisis. Right? And so that to me is the pattern that justifies the analysis of long waves and the analysis of regulation theory. Because to me, that's the best way of thinking about capitalism. That's my argument. Okay. Going more into the details, one of the key drivers of this process, right, the long wave process, with the booms that last 15, 20, 25 years, and then the sharp financial crisis at the peak of this boom, and then the crisis, this financial crisis, a systemic financial crisis, unfolding deflationary pressures, which I will explain to you, so that you have a downswing phase, and then you have this moment downswing where you get the second crisis, like the second shoe drops, right? this process is substantially driven. It's an international process. So what makes long waves relevant also is that they have a global dimension. Okay, and so because they have a global dimension, the contagion, the interdependence, right, the ruptures and how the ruptures sequence each other, cause each other, etc. That makes the international monetary system a crucial mechanism of transmission for this globalization process of a crisis. Both the boom and the crises, both the upswing and the downswing, are fundamentally driven and shaped by the international monetary system that is in place for that particular long wave, for that particular accumulation regime. Do I make myself clear? So in a nutshell, the whole globalization dynamic in the upswing, the deglobalization dynamic, the fragmentation dynamic in the downswing are driven by the international monetary system in place. Okay. But part of that, when you get to that crisis at the end, the transformative crisis that moves you from one accumulation regime to another, that requires a new international monetary system. Right? The accumulation regime that emerges because of what happens to the international monetary regime and how it changes. So it's money, finance, crucial aspects of how this process unfolds, right? Both the crisis and the rebuilding, the reform space. Finance determines the reform space, the amount of space politicians, political programs, and governments have to make reforms. Right? But finance also shapes how these reforms get put together into some kind of coherence. Okay. And by this, I mean finance in the broadest sense of the word. I'll try to explain that at some point, right? I'll try to explain that beginning now, but I will give you a much bigger discussion of money and finance at the beginning of next week when we're talking about cyber cash, when we're talking about cryptocurrencies and digital money, right? It's only then that I will give you my theory of money. Okay. Because my first part, I'm more interested in the long waves and the history of capitalism. Second week, I'm talking much more about finance. Right? So there's a certain pedagogic choice I'm making. Right? I cannot flood you with too much. Otherwise, I'm not good enough. I'm not organized enough. So they have to make some choices in the sequencing of my concepts. Okay. So look, what I didn't do at the end of last class, I didn't go through you with the details of the pattern as it applied to the bimetallic standard of the 19th century or to the classic gold standards at the end of the 19th century into the 20th century, or with Bretton Woods, or with the dollar standard, right? There's the same pattern. That's what I'm trying to mention here. But to show you the full extent of that pattern will take me a long time. It will take me 15, 20 minutes. I don't want to do that. But I'm just going to mention that I'm going to just summarize the pattern once again, okay? The pattern that I'm talking about is how the international monetary system drives the long wave, both up and down. Okay? That's the pattern I want to talk about. So, the bimetallic standard was quite complicated, okay? Because it was an indirect internationalization process, right? And it had a lot to do with the conflict between gold and silver and the countries that were committed to gold and the countries that were committed to silver, right? And then what happened to countries that had both, like the US? There's like an incredible political tension around silver interests and gold interests. The silver interests were the slave-based plantation economies. And more importantly, the frontier economy. Right? The US was a country in the 19th century, 3 different economic systems. 2 of them went with silver, 1 of them with gold. And it almost comes to civil war in the 1870s. So that's still after the actual civil war. There's a huge conflict, right? So I don't want to get into all those details. That's my point, right? But what you have clearly in all those four international monetary systems, bimetallism, followed by the classic gold standard, which is London-centered, followed by Bretton Woods, which is US-centered, followed by the dollar standard, which also is US-centered. What you have through those four international monetary systems, representing four different long waves, you have each time in the upswing, the international monetary system works to promote growth. It's a pro-growth regime. And it's a pro-growth regime because it's a period of easy credit, right? The system encourages financial innovations and stability at the same time, to the point where it promotes a lot of credit. Relatively good terms for the debtors. It's also based on productive capital flows from the center to the periphery, or the semi-periphery, depending what period we're talking about, right? Right now we have we have more than just, we have basically more than just center, semi-periphery, periphery. We have a fourth layer of the BRICS, and Brazil is part of that, which is actually the second layer. Right? So as we globalize more, I mean, the differentiation becomes more complicated. And that means also that the conditions of unequal exchange, all of that stuff becomes much more complicated. Right? And then you have, I mean, I don't even want to go there, but that's, again, we have to have a kind of a meta-economic revolution to understand economic development in its differentiation. But let's go back to the international monetary system, right? It promotes growth. So the second thing is productive investments, capital exports usually, right, from the center going out. And that promotes globalization, okay? And because the third element is that you have the leading currency, the key currency, or more specifically the vehicle currency, through which all the transactions internationally flow mostly, which was the pound sterling in the 19th century and the dollar in the 20th century into the 21st century. The issue of that world money has an overvalued currency. The currency is overvalued relative to the fundamentals of the national economy that represents that money also as a national currency. Okay? All the systems had that, okay? All four systems I'm talking about had the center with an overvalued currency. But this does two things at the same time, okay? It allows the center to have a global reach because commodities and foreign assets are cheap, okay, for that country. And so the country has an overvalued currency that supports its aggressive global reach. Yes? But it also means that other currencies are undervalued. And that makes it possible for several countries to have accelerated growth through export-led growth. And so you get a constellation, okay? You get a growth constellation made possible by the overvaluation of the key currency. So what you then get is you get a process of catching up, a convergence process, where many countries grow faster than the center. The center pulls these countries up. Yeah, makes sense. Does it make sense? So that's the long wave upswing. What happens, unfortunately, it's inevitable, okay, is that this process cannot last. Because it runs into a classic Marxist issue of global overproduction. You get overproduction conditions. When those countries catch up, as they catch up with the leader, more and more strategic industries within which they have fueled their export-led growth add capacities to the point where they have overcapacity, excess capacities. So you get global overproduction conditions, which manifest themselves already as financial instability, okay? Right? Overproduction that was debt financed will give you a financial crisis that's a systemic financial crisis, okay? This goes back to Minsky and his whole theory of financial fragility. The moment the overproduction crisis, okay, causes income to stagnate or to grow less fast, or it go down. But yet you have taken on more and more debts, and at that moment interest rates tend to go up, so your debt servicing charges go up while your income generation goes down. You're going to have many debtors suddenly becoming Ponzi debtors, fragile debtors. Okay, and that's the inevitable part. That's how capitalism works over and over again. It creates its own condition of systemic financial crisis. So that's why you have the bimetallic standard explodes in 1873. The classic gold standard, this is not a financial crisis, this is World War I. Okay? But when you look at why these countries that had not gone to war for decades decided to go to war at that moment, you realize this is in the face of a financial crisis. Okay? And it has a lot to do with how, well, this is a complicated story, but how the relationship within Europe between the powers competing with each other and their allies. Right? It's kind of weird and funny that 110 years later we're going through the same stuff. If you're the European like me, history is like a nightmare. You know? And history in Europe sits like a little devil, you know, on the roof watching, you know. The Europeans are totally captured by their fucked up history. You know, they need to do collective trauma work, which they're not doing. Some do and some don't. There's a whole other story I can tell you about that, right? Because I'm the child of Holocaust survivors. And they killed me, you know, I mean, they destroyed my family, the Germans. But my father hated the Germans so much that he never accepted their reparations money. So when he threw me out when I was 18, because I didn't want to be an Orthodox Jew with a beard and pious and take his business, but I wanted to think and be free, I took his money. He never touched the reparations money. I took it. So I was saved by the Germans just as the Germans destroyed my world before me, my parents, right? So then I felt very guilty, also vis-a-vis the Germans, because I was lying to them. I was the one who took their money, not my father. So I went to Germany to study and live there, and then I realized those guys did the trauma work. You know, the reparations money was part of their trauma work. The Germans are not the same Germans as they were before. The Austrians, where I grew up, never did the trauma work. That's why I left. Between my Orthodox Jewish family and the Austrian anti-Semites, I couldn't live. Right? But when you don't do your trauma work, you're going to go through the same bullshit again. Right? That's the problem. So we're in a very nervous moment, I think, in Europe. Right? But, so for example, when Putin makes his case for Kiev being Russian, that's from 1,000 years ago. Right? What happened? That's what I'm saying. You can be a prisoner of your history. Yes. So one of the reasons why you have to understand these patterns, right? That's the work you have to do in a way. But let's go back. So you have overproduction conditions with this financial crisis, okay? How this becomes global has to do with the currency misalignment that has been building up in the upswing. Remember, I told you that in the upswing, the international monetary system works in such a way that the center with its key currency, which is the world money, has an overvalued currency relative to the other currencies, relative to gold also before. This is how it allows the others to catch up. But when they catch up, they're not like this with the center, but they're like this with the center, right? And so the currencies, the exchange rates, the currency weights are completely out of whack with reality. You have a system of misaligned currencies. And so the financial crisis that starts because of overproduction conditions in key places becomes immediately also a currency crisis. If a debt crisis and a currency crisis combine, then you have a 5-degree fire in your building. That's a very serious problem. That's when you have a systemic financial crisis. Okay. A systemic financial crisis is basically breaking down the system step by step. Financial markets disintegrate, and with them, the funding dependent clients that they have. Okay. Now, you're going to have to manage this crisis. The state and the group of states, they have to manage this kind of crisis. Okay. If they don't manage this kind of crisis, then you're going to have a choice between depression and/or war. Okay. No question about it. It's always happened like that. Financial crises are like the kinds of fires that we see more and more, like wildfires. They spread fast and they destroy everything. Unless you have very good firefighters containing it, managing it, and then dousing it, and it's very much like fire. Right? So one thing that's a great contribution by a conservative economist who felt very guilty not having foreseen the stock market crash of October 1929, was heavily invested in stocks, got completely wiped out, and then felt guilty enough to say, okay, I know I'm a new classical monetarist economist, but I will understand financial crisis, right? This is a guy called Irving Fisher, okay, who also has the equation of exchange at the center of the monetarist thinking in 1911, right? He's a huge economist. The Fisher effect, real interest rates, nominal interest rates, right? So this is one of the great American economists, right? Irving Fisher. But in 1933, he wrote a 10-page paper, which you absolutely have to read. If you want to be an economist in graduate school, you have to read this. Okay. And this is his theory of the debt deflation spiral. Let me write this down. the debt inflation spiral. This is his theory. So when you have a systemic financial crisis, you're going to trigger this spiral. A spiral is like a cumulative self-feeding process of basically of forced asset sales into declining markets. Right? So the debtors, in order to survive, they don't get new credit. They're Ponzi debtors, right? They need new credit all the time. They don't. They get cut off. That's part of the crisis. So then they have to liquidate whatever they have. So they're selling their assets into already declining market because everybody's doing it at the same time. Right? And that then triggers bankruptcies, right? Triggers further financial instability. And so Irving Fisher goes through the spiral, right? What gets triggered when, how, by this sudden rupture of a financial crisis, right? It's beautifully done. Basically, he just looked at what happened between 1929 and 1933 in the US. Right? And he wrote it all up as a theory. Right? But in order to survive, it's like you're in water and you have to go up there, get air, right? You have to get rid of debt and assets. Right? You have to get your balance sheet down. Right? And if you don't stop that process, if you don't stop that debt deflation spiral, like we did not do in the 1930s, then you're going to get a Great Depression. If you stop it, you don't have a Great Depression. That's basically the argument. But if you don't stop it, you're going to have a Great Depression. And if you don't want to get into Great Depression, often it happens that you go to war instead. So one of the traumas of central banks is how they failed to stop this debt deflation spiral in the 1930s. They did not act as lenders of the last resort. And there's all kinds of reasons why they did not act as lenders of the last resort, okay? This is a whole book by itself. Part of it has to do with tensions between the US as the new superpower and the UK as the old superpower, and they couldn't coordinate. Okay, there was real personality clashes. Okay, so leadership is really important in those moments. Crisis, you have to have leaders, okay, that know what they're doing and that have a vision of cooperation rather than conflict. Part of it is that the central banks had followed what is called the real bills doctrine, where when you come to the central bank as the lender of the last resort, you're in trouble. And when you're in trouble, you need emergency assistance. You're in trouble because you're shaky. You're bad. You have troubles. You have problems. Okay. So then the central banks with real bills doctrine said, okay, since we central banks cannot lose money, don't want to lose money, you're going to have to secure your loan. If you come to us, you have to have a collateral, and the collateral has to be self-financed. And a self-financed collateral, the only ones that we accept is industrial and commercial loans. And that's crazy because in a crisis like that, the banks are losing their industrial commercial loans. They don't make new ones because nobody's borrowing, and they have to get rid of the old ones. So they don't have the collateral that they need to get bailed out by the central banks in the 30s. So they failed. They had the wrong theory, okay? Which is a theory that they got from the 1870s. Different time, which was at the beginning of a boom. But anyway, they go to war. There's a depression and war, right? You then set up a completely different system. the war is a transformative moment. Right? So remember, I talked to you about the second crisis being the transformative crisis that gets you from one accumulation regime to another. In the case of the story that I'm telling you from the 1930s, that was World War II. But you cannot understand World War II unless you link it to World War I and the Depression. Right? This is just one process. These are not separated; they're completely connected to each other. Okay. So that was quite the downswing. Okay, you know, having a downswing like that, war, depression, war, man. So there's this strange thing that old people like me are quite conscious of that because we grew up as kids in the aftermath of that, right? And now we're here, and you're like 50 years younger than me, and I'm telling you, hey, wait a minute, you're also going through a lot of trouble. I can tell you that. Right? But let's go on. So when we get to finance-led capitalism, I mean, we have the post-war boom, which is when I grew up, right? And then we have another global financial crisis, which, by the way, now I'm making a point for your question number 2, Euro currency markets. You remember that question? Every day you get a little bit of something added to it. So when you had the Euro currency markets, right? Remember, we were already in Bretton Woods 2 days ago, and we were already talking about that. Right? And you have this catching up process with basically Japan and key European countries, mostly Germany. Right? The enemies of World War II are the catching up powers at that time in Bretton Woods. Right? As they catch up, thanks to an overvalued dollar, you get this dollar surplus. You go from a dollar shortage to this dollar surplus. Remember, I talked about the Triffin dilemma when that happened in 1960, right? Remember that? Then they kind of rearrange it so that they can hang on, right? Despite the inconvertibility of the dollar against gold. But a key part of that is that in that period, the Euro currency market develops very rapidly in the 60s. This is now, we have the beginning of a global banking network, okay, that is transnational, okay, that is beyond nations. And it goes from dollars to marks and yens and so forth. It spreads out of the dollar. And remember, it's at the core, it's these 450 banks that make up the interbank network. They're the so-called transnational banks. Right? They have this SWIFT and chip system, right? And this is all put in place in the 60s and then takes off, right? But more importantly, in the late 60s, this becomes a mechanism of global currency speculation. I repeat, in the late 60s, this becomes a mechanism of currency speculation. In the face of fixed exchange rates, okay, you have a crisis that makes everybody nervous, 1968, and after that, there's a lot of thinking about this is going to collapse. And when it collapses, the dollar is going to fall. And so you have more and more people moving out of dollars after 68. And part of that is also motivated by the fact that the US has very accelerating inflation because it overheated the economy. It has that war, the Vietnam War, for which it is not paying. Remember that story? Erich Streisler, right? And on top of that, the US has ceilings on its interest rates. So it has largely negative interest rates in real terms because it does not adjust its key interest rates with inflation. right? It keeps the ceilings pretty fixed. That's known as regulation Q, those interest rate ceilings. And so all of this makes people run away from the dollar. All these people running away from the dollars will create a crisis, okay? A crisis of the dollar. And that starts in August 1971. That's the official end of Bretton Woods. Okay? And then they try to just like have a new exchange rate regime, the Smithsonian Agreement of December 1971, but it has no anchor. It depends on cooperation, which they don't know how to do, even so they set up the G5, G7, etc. to manage this. And so whatever they adjust the exchange rates in that interim with the Smithsonian Agreement is not enough. And so currency speculation gets more and more powerful. And until in 1973, I remember this as if it was yesterday, March 1st, 1973. I remember it not least because in early March, within that period, I got a letter telling me that I can go to America, for graduate school. But on March 1st, the exchange rates, the currency markets cease. They close for 2 weeks. That's like saying your heart tells you, listen, I'm not gonna beat for like 30 seconds, okay? Right? Get to it, man. The currency markets, that's like the nerve center of the global economy. Yeah, shut it down. Incredible moment. When it reopens 2 weeks later, the dollar floats. There's no more fixed exchange rates. Okay. Now you have a whole lot more complicated stories about currency prices coming from then on. So on the 14th of March, 1973, you get flexible exchange rates. And this is like an explosion, okay? Now you have to figure out exchange rates. So there's this amazing period between 1973 and 1975 of chaos in terms of valuations. But something else that's there that I haven't talked to you about at all, but it is absolutely crucial, is the relationship between the superpower, the energy source of the world, and the exchange rates. There's a whole connection. I do talk about this in the book, right? A little bit, not enough. So in all those long waves, the superpower also has the energy source that counts. Okay. So in the classic gold standard, even before in the bimetallic standard, it's coal and it's Britain. Britain is the #1 coal producer in the world then. Britain had a choice between steam power and coal early on in the late 18th century, early 19th century. There was a huge political fight to decide in favor of coal. Right? Global warming starts right there. If we had gone with steam power and water, it would have been a different economy, and we wouldn't have had climate change. And the reason they went for coal has a lot to do with politics and the class struggle. Also, that's a whole other story. I'm not going to talk to you about that. It was not an innocent choice. But when you get to the US domination, it's oil. Okay. And the US begins to be the oil producer. Okay. Afterwards, of course, other countries take over, right? And now the US is back. It's a long story, right? But you have oil, and then after World War II, with the dollar standard, it's oil and gas and nuclear power. It may very well be that in the next accumulation regime, the ecological one that I'm talking about, right, we're going to be to renewable, and this could be European Union or this could be China, not the US. That's the whole point. The US is not going to be a leader in renewable energy. I can tell you that. Only with a major political change is that possible. Even so, this week they will pass an investment in renewable energy that they did not have before. Right? So that's already an important beginning. But they're so far behind the European Union and China, and this is one of the reasons why you will have the end of the dollar stand. But the other thing that I want to talk to you about in the connection between energy and the superpower, right? Is that there's typically an inverse relationship between commodity prices and the exchange rate of the vehicle currency. If the exchange rate of the vehicle currency is high, commodity prices are low. If the exchange rate of the vehicle currency is low, currency prices are high. Okay? I can explain that, okay? And it's a complicated story, and there's certain transmission mechanisms that are feedback loops, right, in this relationship, right? But what it meant in this practical case, because I'm telling you a story of history, right, is that the moment the dollar goes down, first 7 and then 17% and then 23%, goes down a lot. This sets the conditions for the oil price explosion in 1973, and then again in the next dollar crisis in 1979. Of course, you had the Yom Kippur War and you had the Iranian Revolution, but this is just the trigger moment. Okay, this is just like somebody throwing the match into what is already brewing there as an explosive mix. Okay, most people are scandalized by this match. They don't understand that there's a brewing mix there that will explode. Right, you have to see both things. So you have these oil price explosions, not least because the dollar is in crisis twice, really badly. And this is together in the feedback loops, right? The euro currency markets are crucial because they are the drivers of these violent adjustments. They push that. But then they also push this huge petrodollar recycling process. So once the oil prices explode, the oil producers get a lot of money that they're not allowed to invest directly in companies in the West. So they have to, the Western powers don't want to have that money. So they put it in the euro currency market, and the euro currency market then distributes that money to all the oil importers. This is known as petrodollar recycling. Sorry. Man, it's impossible. I've never managed this thing. Right. So it is this moment in the stagflation crisis of the 1970s, which is a global mechanism, okay? You have this global recycling, right, in the euro currency market, where it becomes the equal to the collection of central banks. Right now, you have an international monetary system with two powerful pillars. Not just the public, but also now the private, the banks, the euro currency market, the global banking network. Okay, and this forces the deregulation of money and banking, right? The stagflation crisis breaks down any of the pillars of the financial regulations that were set up in the 1930s and 1940s. It breaks them down one by one. So out of this comes a different finance. The US deregulates finance. Exchange rates have been deregulated. Now you have flexible rates. Interest rate ceilings abolished, phased out. So now you have market determined rates. Once you have market determined rates, the system moves from the banks to the financial markets. Okay. The financial markets become more dominant than indirect finance through banks. To drive the financial markets, savings move from banks to a new type of saving funds. First the pension funds, then the mutual funds, then the hedge funds, then the private equity funds. Now even government have funds, sovereign wealth funds. And so finance transforms itself. But it transforms itself, and this is the emerging dollar standard, right? The US comes back by setting up a different financial system, okay, where your life gets financialized, okay? Your life gets financialized. You guys, I mean, not you guys because you're students, but these guys, they get a pension when they get 68 years old, being like I was in France, right? Then you get a pension, right? You don't even think about it. Well, maybe you think about it. But it's a pretty standard thing, okay? You know in advance, pretty much. That's not like in the US. In the US, you don't have that, okay? In the US, you get a small pension from the state. You have to organize your own pension. Same in China, by the way. But in China, you don't do funds. In China, you do banks and shadow banking. In the US, you do funds. And you do funds because it's all tax sheltered. Right? The government says, whatever you accumulate, it doesn't get taxed. Don't worry about it. And it's true. When you put your money in there regularly a little bit every month, then after 30 years later, you're like a millionaire because of compounding. Right? 10 years not, 20 just beginning, but 30 years, yes, it goes up like that. Okay. And you tell people that, and they say, yeah, let's do that. But in the US, you also have to pay for your education. So you have education funds. The moment the kid is born, it's like baptism. No, baptism, forget about it. Funds. 5 to 9 funds, or whatever. There's lots of different types of funds, right? It's like if you don't do that, you're not a good parent. And then I have to tell you that. Healthcare. Healthcare is very expensive in the US, and it's not fully insured. Many times it's not at all insured. People go from totally uninsured to very well insured, like professors in America. They're well insured. Right? But my daughter, who's about to be 26, she's going to drop out of my insurance automatically, 26, and she's not a healthy person. If we don't do this well, and we're unlucky, we could be like $1 million in debt. Last year, they spent $187,000 the insurance company, right? I paid about $10,000 because even then you have to pay yourself a little bit just because my daughter was sick. So you have to have funds for that. I didn't, and that's a problem. So you financialize your life, right? The key things that are public goods are also totally costly privately in the US. Pensions, education, healthcare. So you as a person with me, you have like parents, right? They're not, even with Medicare, they're not fully insured. You have to deal with them dying. My mother had lung cancer for 5 years. And then you have your kids, which I had late, in a way, luckily, because I was already quite rich when I had them. But everybody as a middle-aged person is like the kids and the parents, the kids and the parents. It's like, your money. It's a crazy system. So this is what I mean by financialization. You're gripped into this power in the financial system, right? This is not the state. This is your bank and your fund. So this type of finance becomes dominant. So this is why I call this long wave, some others call it too, finance-led capitalism. And by the way, I gave you my other 2 books that I wrote recently, but I didn't give you my finance-led capitalism book. I should do that if you're interested. I might as well give it to you and you post it, right? If you want to read it, okay? Even if you don't want to read it, the first chapter you should read. I'm proud of that chapter. That's a detailed account of the crisis of 2007, 2008. you know, because really it was like a little bullet goes off, hits this, okay. I mean, a slice of the American bond market, right? But then this bullet flies around, and each time it gets bigger. So when it ever hits, it makes more damage, and then has even more jazz power to hit the next thing bigger. And so this is an incredible process. Nobody had a clue because nobody saw that kind of connection. Not even the people who created that system, the shadow banking system, knew all the connections. Crisis is good because you see connections that you never saw before. Yeah? Because you see the ruptures. You have to look at the ruptures. Without ruptures, you don't see the connection. It's underneath the water. Right? So I said, okay, let me follow this. But so the thing that I'm trying to talk to you about now is that in this crisis, 2007, 2008, you had to make sure that you manage this crisis. Remember, there's this trauma of the central bankers about having failed to do this in the 1929, 1933 period, right? And in an incredibly strange, but not so strange moment, the central bank head of the US, Alan Greenspan, who was a libertarian, okay, who was totally free market, who was a follower of Ayn Rand. I don't know whether you know Ayn Rand, okay? That's like the most pro-capitalist philosopher you'll ever get, okay? And he had managed this finance-led capitalism in a very aggressive way. He had some thoughts in 2005, right? When he was watching this bubble. The only thing that he ever published while he was for 14 years the Federal Reserve chair was an article that he wrote with the chief economist of the Federal Reserve Bank of New York about housing bubbles and the wealth effect. And so he had a sense. He said, let me get a guy who understands financial crisis and deflation. Ben Bernanke, yeah, that's the guy. Ben Bernanke was like a professor in Princeton. Princeton has an incredibly good financial economics section, right? Famously good. But he was a professor, and he was studying financial crisis and deflation and cycles. And he suddenly became the vice chair of the Fed in 2005. And then he became, before that, in 2001 or 2. And then in 2005, when Greenspan left, he became the chair of the Fed. This is the best guy to have chosen. Okay? This was a good choice. But because what you had, and this I should have started my class. Now it's like 55 minutes later. With this finance-led capitalism, right? The boom, the dollar standard, how it fed this wave of globalization, how it turned Brazil into an emerging market economy, flying on the edge of a commodity super boom. But the system that emerged, that broke down in 2007 with this crisis, okay, is a system that, where the Americans, with their financial system, do two things, right? They send a lot of money abroad, but not just direct investment, more and more portfolio investment. So you get financial markets in the rest of the world. Okay? Because now it's not the banks, it's the funds that do that. And the funds, they make little funds. They split off. They're much more flexible than banks, right? To propagate themselves. But the other thing that happened is inside of the US, you get bubbles, asset bubbles. You get people who want to get rich quick in the financial markets. My students at Hofstra, right? You can look, I've been teaching for 47 years or something, right? I can see every generation, right? This generation, very smart kids, they should have been engineers. Nah. Finance man. Of course, then they go into all kinds of crises because they work 90 hours a day, a week. They do immoral things. They all, I mean, they get their crisis, but when they're 30. So. But you get bubbles, acid bubbles. You get 3 big bubbles in a row. In the 80s, stock market bubble, the corporate raiders. The corporate raiders attacked undervalued companies. They were like legendary financial characters, okay? Like Ivan Boesky, Carl Icahn. They're a whole group of people that were run by key brain, Michael Milken, who run Drexel. Drexel invented junk bonds. Junk bonds and financed those guys to attack the largest companies in America, which were undervalued coming out of this deflation crisis, right? When you come out of a crisis, you're undervalued. The stocks were undervalued, so they were attackable. So this is known as the raiders, right? And they create a stock market boom because everybody else goes with the raiders, right? This then does a couple of things that are important, right? In this, when they get attacked, they try to defend themselves or they give up. When they try to defend themselves, they go to the funds and says, back me, don't go with those guys. And the funds say, I'll back you, but I want to get a higher stock price. So I want you to change your priorities. So one lasting effect of that stock market boom, which crashed in 1987, October 1987, was that you had a new principle of how corporations are organized. Shareholder value maximization. That's the key. Becomes the number one priority for managers. And they reinforce this by how they get paid. They get paid with stock options, not with money. So part of dollar standard, part of this long wave is a different way in which corporations are organized and how they're run. With shareholder value maximization. The next boom is internet, .com boom, .com bubble. The internet appears in 1994, okay, as the internet. It was there before, but it was not called the internet. It was called the ARPANET or whatever. Right? But it gets a browser that's global and gets some companies that are in that browser, and the bingo. The rest is history. Within a few years, you see the potential of the internet. Especially network effects. This is like a crazy system with incredibly powerful network externalities. So people go bananas and they have the .com boom, right? And then the .com bubble. And part of this is also that you're setting up a new stock market where you allow companies that have no profit records to be listed, and that's NASDAQ. And NASDAQ is just like a crazy, crazy, crazy place in that time, right? So it's like a bit like cryptocurrencies. The bubble crashes, as all bubbles crash. The way the internet bubble crashes is incredibly important in terms of who survives and who doesn't. Okay. And so, for example, you had like 8 search engines, all kinds of weird, Ask Jeeves, Yahoo. Google comes out as the one that survives. You had all kinds of delivery companies. Amazon comes out as the one that survives, right? And they come out of this crisis far bigger and stronger than before because they're picking up all the other pieces of the other ones that collapsed. But anyway, then you get the third bubble is the housing bubble, the real estate bubble in the 2000s. This is a totally crazy bubble because The bubble consists of the fact that the banks can give you a mortgage to buy a house, and then they don't have to wait anymore 20 years for you to pay it off. They wait 20 minutes before they sell off their mortgage. Right? That's at the key of all of this, at the key of mortgage-backed securities or credit default swaps, all that stuff, which builds a whole shadow banking system, okay? But the essence is that you can rotate your money, or turn over your loans incredibly much faster than before, make a lot more loans to drive up the price, and then have people borrow against the appreciation. And so you have a very powerful wealth effect. Because in America, you can renegotiate your mortgage right away, anytime. You can also take out a second mortgage on top of the first mortgage for the appreciation. You can take out a home equity loan where you take out more money, but you don't have to spend it on improving your house. You can spend it on whatever you want, gambling, your education of your kids, whatever. So the way the financing works is that 63% of Americans are homeowners, and they go and they basically use their house like a cash machine. As long as the prices go up. Of course, the prices at some point go down. That's the problem. And then you have this amazing financial crisis, which becomes rapidly global. Because all these mortgage-backed securities that are driving this crazy real estate boom in the US were rated AAA, and they were structured to be AAA, but they were never AAA. Okay, it's a joke. Right? In the book, I really explain how this works, right? So I don't want to get into it because I'm already far behind my today's pace. What I want to talk about is different. What I want to talk about is the crisis management. Because this time you do get crisis management. And you get spectacular and stunning crisis management. But the crisis management is also in and of itself problematic. So that's a key theme of the next few minutes. So one of the things that we do in the face of this crisis, we set up a new coordination mechanism for crisis management, the G20. Okay. It gets set up in 2008. And it was there before, but before it was like ridiculous because it was just finance ministers talking to each other without anything. Now it's the head of the states. It's Lula, It's not Guttmann. And it's the president of the US going there. It's Obama, And so they said they agreed to do three things. To meet every 6 months, rotation, different places. And they also agree that they're going to be the 20, but they're going to invite whoever they want to invite. Whoever is the host can invite whoever they want. So it's always more than 20. Okay? They agree to have communiques that they adhere to. They're going to negotiate. During the period of crisis management, that was important. After that, the moment the crisis is over, they start not doing the things that they promised themselves to do. But during that period, the first few years, they did an amazing job. Okay, the leaders of the world. Okay, so they make agreements, coordination of the crisis management, and it worked. It worked. They did avoid a Great Depression. So they did a combination of things. Okay, they bailed out their key banks. They set up emergency lending facilities beyond banks to whoever needed money that couldn't get it through the banking system. And also the emergency lending facilities allowed loss socialization of funds and other and different financial institutions could survive because they had this access to special types of funds that allowed them slowly to take their losses slowly, to socialize their losses. For example, the Fed set up 23 emergency lending facilities, looking at all the damage, and they used 7 of them incredibly at a very large scale. They used 6 or so, not a lot, but a little bit, and just for a short period of time or whatever. And then 10 of them they didn't use at all, but just having set them up, but everybody happy. Everybody got calm, took away the panic. And maybe of those 10, 4 or 5 were useless, that they were badly designed or whatever, okay? But this was good enough. They also did fiscal stimulus, not enough in the US, not enough in the European Union, lots in China, lots. So China was the one that actually carried the world economy out of this mess in terms of its demand engine. There's a demand engine. They also made a promise to each other not to start protectionist wars, trade wars, which are very typical in the downstream phase in the past. And then in the third meeting, Pittsburgh, 2009, they agreed to re-regulate finance on a global scale. Okay. And they did, starting right away, 2010. The process lasted till 2019. Financial re-regulation. And they had 2 parts. One is a global agreement to re-regulate banks differently. That's known as Basel III. Okay. And in a nutshell, Basel III does 3 things. That's not why it's called Basel III. It's called Basel III because it's the third agreement under the auspices of the Basel Committee of Banking Supervision, which is the key part of the BIS that I talked to you about, right? But Basel III redefines bank capital, what bank capital is. And then puts much higher minimum levels of bank capital in place. Okay? And it depends what bank you are. There's 5 different capital buffers in Basel III. Some banks have all 5, some banks only have 2 or 3. Okay? So you also get a different classification of different banks. But those banks that are too big to fail, they're now officially called, after this regulation, systemically important financial institutions. And you can have regionally or domestically or globally systemically important financial institutions. They will have different capital requirements. Okay. But instead of having 3% capitalization level, that is the ratio of capital to assets, the banks now have typically between 10 and 15%. And what counts as capital is much, much tougher than this freaky stuff that disappeared right away before in a 3%. We had tier 2 capital, tier 3 capital. This is bullshit. This is just like worse than my toilet paper. The tier 3 capital was completely ridiculous. Now you just have tier 1, and then you have a layer which is important when you reorganize banks. You have bonds that become shares. This is called contingent convertibles, COCOs. And so you can have a layer of COCOs and make them shares when you're in a crisis rather than bonds. Okay. This, by the way, actively exists only in Europe. Okay, you don't have COCOs in Brazil. I don't think you have COCOs in Brazil. You don't have COCOs in the US. You have something like that in China, but it's not called COCOs. And no, there's no market. It's completely between the central bank and the banks. And you recapitalize the Chinese banks. But there's a market, right? Which, by the way, is incredibly interesting. You could see what the market thinks about banks when you just look at their COCOs prices. Okay. Note that if you work in banking, you're dealing with European banks, look at their COCO prices. Yeah. But anyway, so this is the first part of Basel III. Okay, much more capital, and the capital is defined much more solidly than before. But you also have different layers, different levels, minimum levels, depending what kind of bank. And the domestic regulators, usually the central banks, can even have more. These are all minimum, okay? So the Swiss banks have more now. And some American banks also have more by domestic regulation. Then Basel III has a second pillar, which are the liquidity cushions. Before that, let me just ask you a question. Why is bank capital so important? What's the point of bank capital? Any thoughts on that? So what is it good for? I'm glad I asked you this question, because you seem to be clueless, or are you too shy? You wanted to say something. No, you, the one who looks like me with Streisler. You, yes, I don't know your name, but you Pakistani perhaps. Go ahead. Tell me. What do you know? What bank capital is good for?
I think that when a crisis-like situation occurs, then cash liquidity can be.
No, this has nothing to do with liquidity. This is a problem. It's a problem of solvency. So when are you insolvent? When are you bankrupt? Bankrupt because of insolvency. There's more than one reason to go bankrupt, but the biggest reason to go bankrupt is insolvency. Insolvency is when you have lost your capital. You no longer have capital. You have zero capital or negative capital. How do you get to that point? When you have losses, you have to write them off your capital. When you have profit and the retained earnings of your profit, you add to capital. So capital is basically the accumulated stock of all your gains, retained earnings, minus your losses. That's the book capital, okay? That's the balance sheet capital. Whether the balance sheet capital equals your market capitalization is a different question. It doesn't have to. And the relationship between book capital and market capitalization is very interesting, okay? It's the James Tobin's Q ratio. It tells you something about the company. Tells you actually a lot if you want to see that, okay? But let's go back. Bank capital is the cushion against losses. You can have as many losses as you have bank capital before you become insolvent. Do you understand what I'm saying? So if you don't have a lot of capital, you don't have a lot of cushion against losses, you fail fast. If you have a lot of bank capital, you can take a lot of losses without going under. Do I make this? Is it clear? Tell me. Any questions? Yes.
Professor, here in Brazil, we have maybe Professor Leana can think I'm right. Nosso compulsório, os bancos, would be this bank capital.
No, it's liquidity.
Okay.
No, it's reserves and other things.
Right.
It's not capital.
Do not confuse reserves and capital. If you're an economics graduate student, and you don't want to be ashamed of yourself, make sure that you get. Okay, I'm sorry, you need to know that, right? So, but let's talk about this, okay? Because there's the second part of Basel III is the liquidity cushions. Look, banks have two problems. They can be insolvent or illiquid. Okay? Insolvent is that they have losses, and they have to write them off. Like you have a loss when you make a loan and the guy doesn't pay back your loan. And you have a loss. You have 90 days, and then it becomes something that you have to set aside. And then there's regulations, there's accounting rules when you have to take those losses. But banks have a liquidity problem. Okay. And the reason they have a liquidity problem has to do with fractional reserve banking. So when I'm a bank and you are my depositors and these are my other clients whom I lend money to, okay? You giving me money, that is always your money. Every time you come, you have it. I have to give it to you, no matter what. This is not my money, this is your money. But the moment you're giving it to me, it's also my money. Okay? It's both your money and my money. And the way I'm resolving this problem is I'm telling myself, not all those guys will come at the same time. I don't have to keep all of their money. I know that this guy comes to have a steak on Wednesday, and this guy comes because he wants to buy new shoes during the weekend. I know my clients, and they come at certain times with certain fractions of money. So in the meantime, I can take that money, keep a little bit on the side in case they come, have it there, and I'm going to take their money and I give it to them. Okay. That's how banks work. You understand that banks are banks, commercial banks, because they take deposits and they make loans. And when they make loans, they create new money. Old money doubles, almost doubles, because there's also reserve requirements. The stuff that I set aside, 10% of what you're giving me. I said, you give me 1,000 reais, I put aside 100 reais. I take 900 reais, I give them 900 reais. And the 900 reais are new money. Okay. Does that make sense? So the key idea for me as a bank is that I charge them more. On those 90%, then I pay you on the 100%. On those 100 reais. I pay you 2% on the 100 reais. I'm going to charge them 4% on the 90. I'm coming out with a profit. Right? By the way, I will tell you later, before the exam on the last class, that model is about to go because of central bank digital coins. The introduction of this new type of digital money is going to make this obsolete. So when you start working for a bank, think about it. You're going to be in a different animal, working with for a different animal. I mean, I can say this because you're young and you're going to work for 30, 40 years. You know, you're going to live through this change. It's not going to happen tomorrow, but it's going to happen relatively soon. 5, 10, 15 years from now. But let's go back. So because of the fraction, we call this fractional reserve banking. Right? Because banks only keep a fraction of their reserves ready for withdrawals. The rest they loan out. That's how they make profit. Okay? But this creates a liquidity problem because they don't have money. The money that they're promising you, they don't have. They only have a fraction of it. So they have to have liquid, they have to have some of their assets very liquid so they can get the money back and then give it to you. You come in there, you take money and they say, okay, wait 5 minutes. And then boom, 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 and they have the cash and they give it. No problem. But they run out of liquidity. You know, it's not that impossible for them to actually be in liquidity problems because they also have liquidity issues. They have market liquidity issues, funding liquidity issues, and monetary liquidity. There's actually 3 different types of liquidity. That's a whole other financial theory that I'm trying to figure out. Okay? Because that's not something that gets well discussed among not even monetary economists. That you have very different types of liquidity. Okay? And that's why the structure of the financial, the structure of finance is very important in how the different levels of liquidity can interact in a moment of crisis. Whether you have more markets or more banks or whatever, each country has its own financial structure, okay? And that becomes a really important thing in the moment of truth, which is when there's liquidity issues. But that's a whole other story. I'm not going there. I'm just giving you a hint, an idea of something to think about. Now, the financial crisis of 2007-8 was 4/5 a liquidity crisis before it became a solvency crisis. So Basel II imposed liquidity cushions on banks. One is called the liquidity coverage ratio, LCR. Okay, and that means that the banks have to be able to survive a liquidity crisis of the kind that they had in the middle of the 2007-8 crisis. There were three major liquidity crises in that period, right? They lasted up to 18 days, the last one. And they have to survive net cash outflows every day for a month. They have to have enough liquidity to survive that. That's a pretty stringent measure that completely has impacted on how the banks operate. Okay, they're less aggressive. They're desperate for liquid assets. That's one reason why the U.S. Treasuries market got into trouble, because it's not big enough. The U.S. needs to run more deficits. Okay, but that's a whole other story. Then you have the second one, which I gather you'd work on, right? The net stable funding ratio, which has to match liquid assets and liquid liabilities, okay? The liquid assets have to be structured, matched over a 1 year period. You have a 1 year period where, because liquidity is a matter of 1 year, okay? The instruments that you use that are liquid instruments are between tomorrow and 1 year. And you have to structure they have to match. Right? It's a complicated formula, okay? And makes a lot of work for banks. Lots of people get hired to do that, not just you. You know, in Paris, our masters, they were all hired for either risk management or liquidity, I mean, whatever, right? It creates a lot of, these regulations create a huge amount of jobs, okay? That's another thing. And then, and this has to do with shadow banking, the regulators know that the banks always have a whole other system going that's not regulated, that's hidden from the regulators. That's called shadow banking. Part of the regulation with Dodd-Frank, the other part of the regulation that I'm talking to you about, right, is to make banks talk much more, show the regulators a lot more about their shadow banking. Okay. But you have what is called a leverage cap. That's the third pillar of Basel III, right? And the leverage cap basically means the maximum size of a bank, everything included, without any consideration of risk. Right? 3%. So it's basically you know, they say, okay, if you like 1.80 meters, then you need to have size 10 shoes, at least. Okay. Right. And if you're like 2 meters, you need to have at least 12 each. I mean, you don't have 12, 10, whatever. You have 45, 40, 45, something like that. So yeah, you understand what I'm saying, right? So there's a relationship. It's basically a restriction of your size. You know, your capital needs to be, the feet need to be able to carry your size. But also, when you have only that amount of capital, you cannot be that big. You know, that's the other side of that regulation, the leverage cap. Okay. So there's also Basel IV, supposedly starting next year, which has to do with a bunch of things, but the key ones are the risk management models. Okay. I don't want to go there. So but then the other part of the financial deregulation was a whole set of principles that they agreed on in the Pittsburgh Agreement of 2009. And the key one has to do with systemic risk. You have to manage systemic risk. That means you have to approach, as a regulator and as a central bank, you have to look at the financial system as a whole, as a system. No longer just individual players that you can help or bail out or restructure. Take a look at the whole system and see what it does. So you're managing systemic risk. And so we set up new regulators for that. The new regulators are just umbrella organizations of all the financial regulators. They get put together. Okay. So in the US, this is known as the Financial Oversight Supervision Committee. In the Europe, it's known as the European Systemic Risk Board. And these umbrella group of regulators, which is the central bank and then the financial regulators, and the treasury usually too, the finance ministry, they study the system in terms of systemic risks. By the way, in Dodd-Frank, which is the American version of this part 2 of the financial re-regulation, right? 2,500 pages of banking regulations and finance regulations. They set up a special office to study systemic risk, right? Which is the Office of Financial Research, OFR, okay? They do incredibly interesting work. Go and study it, right? The website is financialresearch.gov. And they do interesting stuff like social network analysis, okay, to look at interconnections, right? And the fragility of interconnections. Or they figure out how do over-the-counter markets, which are networks and not markets, become markets. And what happens? These are incredibly interesting. These are very, very interesting. And the other thing is that they have Minskin people and they have Bernanke kind of people. They have all kinds of people working there. All right. But you also have two other things that are tied to this, okay? One is you're stress testing banks now. You tell banks, first of all, you have to figure out which of those banks are special, which of those banks are what we call systemically important banks. Because part of the systemic risk management is to know that certain banks, when they go under, the whole system gets sick. They're too big to fail. And so these banks, you have to put through stress tests. Okay. So you give the banks, the regulator gives the banks scenarios of crisis and see whether they survive or not. And they do their analysis and you do the analysis, right? So any stress test is double. The regulator does it with the scenario and what the information it has from the bank, and the bank does it. And then they meet and they look at it and say, okay, what do we see here? Right. And so then they know whether they have enough capital, and if they don't, they need more. They know whether they have enough liquidity cushions, and if they don't, they need more. Right? And they do that. But the other thing that the central banks, the systemic risk management umbrella organizations, FSOC and ESBR have, and the England is the Financial Control Authority, they have huge powers, which we don't even know how many powers they have and what they're going to use it for what is called macro-prudential regulation, to stop systemic risks. They have carte blanche, how do you say this in English, right? Free hand to basically stop practices and lower risk and do all kinds of things, okay? We don't know what they're going to do because they have not used it much. Okay. You also have, this can go on forever, but you have another thing that's very important in this re-regulation is the banks, when they fail, they will not get bailed out anymore by the government. This made a lot of people very angry and also cost the governments a huge amount of money. So now you have a new regime for failing banks when they fail. First of all, you supervise them regularly and you judge them as they're failing and as this is called canos. And as you go there and then you see them in trouble, you tell them, listen, you got to do this, this, and this, and this, and that. And you're going to stop this, this, and that, and that. Okay. So all the banks get supervised and they get grades according to capital, assets, management, earnings, liability, liquidity, and systemic issues, which have to do with computers and stuff like that. And then, if the banks fail, they have to restructure themselves, or they have to accept to get liquidated. This is known as a resolution. Okay, but this is set up so as not to have these incredibly expensive bailouts of banks anymore. And just the idea for the banks, for example, in America with Dodd-Frank, the banks have to give living wills. They have to tell the government every year how they want to die. If they die, how do they get liquidated? And just them thinking about it means makes them more careful, right? It makes them like, hey, maybe I don't want to die. There's other things. Another thing in this financial regulation that all the countries did, but some did better than them, is how to strengthen markets, especially how to transform over-the-counter markets, which are not markets, they're networks, and they're typically insider networks, okay? How to transform them into actual public exchange markets, and if not, how to insert a counterpart, a third player that guarantees both. Okay? So all the financial markets have been reorganized a lot, or not so much, okay? That's a very interesting story too. How far they're along with that. So, okay, so now finance is not the same thing, okay? But you can see that when you think about finance, that capitalism has a crisis and then it gets re-regulated. This is a crisis of the mode of regulation when you think about it in regulation theory. Now, good. This was only one of four things, okay, that was crisis management, right? We already talked about fiscal stimulus, which is basically government spending or tax cuts to drive the economy out of this recession. We talked about financial re-regulation. We talked about the emergency lending facilities, okay? But now we have to talk about quantitative easing. So, in order to, one of the things that you don't want to have when you're facing this systemic crisis and its impact drives you into this debt deflation spiral. The idea, and this is definitely Bernanke, okay, is to just flood the system with liquidity. Just pump huge amounts of reserves into the system. Then people don't have to sell. People do not have to do asset sales, forced asset sales into declining markets if they have emergency direct access to liquidity. But the other reason why you want to pump huge amounts of reserves into the system, I mean, create lots of liquidity in one stroke, is to get the banks again to lend. You want to have them come up and say, okay, I'm a bank, I survived, okay, let's go, because the banks are like, they go from greed and giving you a dog a loan, not just you, to like, you're a professor, you're a big risk, I'm not giving you a loan. In one day, they switch from greed to fear in a panic, and then they're like, for years, they look at you, no, I don't want to, no. I don't want to deal with you. And so the banks, they typically, this is Keynes's precautionary motive for money, for cash, right? They just sit on cash. So if you force feed them with lots of cash, maybe it'll trickle out of their panic-stricken, trauma-behaved resistance, and it finds its way somewhere else. or you bypass banks and you pump markets. That's the key, right? The other thing is you do quantitative easing to boost financial asset prices, precisely not to have this debt deflation spiral. And then you get, people become more optimistic. The markets are bad, blah, blah, blah. In America, that's huge. In America, like little kids know about financial markets, okay? Like when I look at Brazilian television here, you have like 12 different stations of religious people. Igreja, this or that, Pentecostal. In America, it's financial channels, right? The kids stand there like they go from Snoopy Dogg to Joe Kramer, who's a crazy financial guy that all the kids love because he's so fun. I mean, my first year students are like, they're in the stock market, or they're in cryptocurrencies or whatever, right? Everybody wants to get rich quick in America, but it's also, you have a lot of financial pressures that you don't have here. So, quantitative easing. Basically, central banks are the only institutions that have the power to write indefinite amounts of money against themselves. They can just write a check against themselves. You want to have $1 trillion economy? Okay, I'll write $1 trillion here and I put it in the banking system, right? That's the power of central banks. They can do that. That gets a lot of modern money theory people quite confused, okay? Let's be clear about that too, right? Because there's a little bit more to that process, okay? But if they have to, they can create lots of liquidity. And the quantitative easing is precisely large asset purchase packages of the central banks. And whenever they buy these assets, they pump liquidity into the system. They create reserves. They create new money. They create reserves. Then when the reserves get activated for lending and so forth, then it becomes money. Until then, it's just hard. It's just the monetary base. It's M0. Okay. It's it's potential money more than actual money. But the point is that you're pumping a lot of liquidity into the system. The US started this already in 2009. Okay. And since then, it has had 5 different packages of quantitative easing. And then the growth in the great pandemic, it did the 6th package, which was like 3 times as big as the ones before. So that also means that a central bank gets bigger and bigger because it's expanding its balance sheet. Yes. So the Fed was like 800 billion at the moment of the crisis, March 2007. And it grew all the way to 9 trillion, 10 times the size. So you go from a 6-foot guy, 180, to an 18-meter guy. The question now is, how do you shrink back? That's a problem. Okay, that is a problem. I can tell you that. But now they have to shrink back. It's like a big balloon, Macy. In America they are all these huge balloons, right? You have to deflate them. But what's happening, and this is very, very important, I was trying to argue this in the book, right? When the US did that, it pushed the dollar down. This is the period of monetary protectionism. Remember, we're now in the downswing of the long wave. And in the downswing of the long wave, the international monetary system turns against itself as an anti-growth machine. It's a pro-growth machine in the upswing, then it creates a financial crisis, then it becomes the perverse opposite, an anti-growth machine. And the anti-growth machine has to do with competitive devaluations. One power devalues and forces the others to devalue. So the sequence is one power devalues, that means the other currency revalues, and that squeezes that other until they have a crisis, and then they start quantitative easing, and then they devalue their currency. So this goes from the dollar to the euro. The euro starts having a crisis October 2009. An almost existential crisis. Bigger than the 2007-8 crisis in the US. And I mean, they are not prepared. They don't have the institutional setup. Okay, so they not only is the crisis more intense, but they have to set up institutional mechanisms that they lack because they never set it up right. They never set up the Eurozone correctly. Okay. So they have to they can't just do quantitative easing like the Fed. Okay. They have restrictions in the Maastricht Treaty that set them up. And so this is an incredible job to manage. But they manage. In this 3-year crisis of the Eurozone, right? First they set up European level regulators. Before that, they didn't have that. So they set up the European system of financial supervision. Right? So they set up a European Banking Authority. They set up the European Securities Market Authority, which is their SSC on the European level now. They set up the European Occupational Pension and Insurance Authority, which is for the funds. And then they set up this Systemic Risk Board, European Systemic Risk Board. They set up 4 European level regulators. Then they set up what is known as the banking union. Actually, before that, they set up a lender of the last resort known as the European Stability Mechanism, ESM. They have to bail out 5 countries, okay? And so they're doing this in a complicated way, whatever, with the Troika, with the IMF and the European Commission, but also the European Central Bank with this European Stability Mechanism. Then they set up a European Banking Union, a resolution mechanism, a supervision mechanism, and a deposit insurance mechanism. They have to set up a European infrastructure for what is still a nationally fragmented system, okay? But that has the same currency. All right, but they also do, starting pretty late in 2015, they start massive quantitative easing, even bigger than the Fed. And this hits an already fragile China. China starts becoming fragile already in 2014. This incredible aggressive expansion of China coming out of the 2007-8 crisis creates its own domestic imbalance, okay? And so the growth slows automatically. They have their own slow motion overproduction crisis. Part of that they get rid of with the Belt and Road Initiative, aggressive expansion, building stuff abroad. Part of it is they absorb with slower growth. Part of it is they allow shadow banking to speed up. And so they have all kinds of things going on, right? But they're definitely in a vulnerable state. And so when the euro gets driven down fast, it hits the renminbi. There's this moment of a renminbi crisis. The only time that the renminbi was in crisis, right? In, what was it, October 2015? No, August 2015?
Yes.
August 2015, yes. And so then the Chinese changed completely their strategy. It's a small crisis from our point of view, but for them it's a huge crisis. It puts into danger their whole regime of exchange controls and capital controls. And they respond very aggressively, as they tend to do when they have a crisis, right? And then, of course, all of this propagates the crisis, okay? From the US to the Eurozone, from the Eurozone to China, and then feeds back. And the way it feeds back already with the Eurozone in crisis is that the commodity super cycle breaks, busts, goes down. This is a disaster for Brazil, okay? And already in 2014, the commodities prices go down, but then they go down in a really deep spiral fast. Brazil is very dependent on commodity prices. So you have this kind of very deflationary period, right? And you have what I call monetary protectionism, right? You have competitive devaluations, right? You have so the idea is quantitative easing drives the currency down, hits the others. They have a crisis. They do their quantitative easing, that pushes their currency down, and the next block then gets hit. Do you understand what I'm saying? This is already like Manchega, your finance minister of Lula, understands this, who was a professor also here, right? At some point, no? I don't know. Huh? Okay. Fair enough. Gilmo was here, right? Anyway, doesn't matter. He understands it already in 2011, or he calls it currency wars, right? Which is exactly what it is. Because, listen, this is what you have to get from this. When you devalue or depreciate a currency, right? It's the same as giving a subsidy to your exports because it makes your exports cheaper. And at the same time, you put a tariff on your imports because a devaluation of a currency or depreciation of a currency makes your imports more expensive. So you're making your imports more expensive and your exports cheaper. That means you're stimulating your domestic economy. But at the expense of the others, okay? Who get to the opposite. There, when your currency goes down, their currency goes up, and their currency goes up. The imports get cheaper, the export gets more expensive, and they get squeezed. All right. So at some point, this runs its course. Okay, when it hits China, and then the commodity producers. That's exactly that moment Trump gets elected. He gets elected on the day that I arrive here with Kregel.
Yes, everything. And
we stand at CPV for hours crying. I've never seen Kregel cry. Okay. He's a guy I know from my childhood. Okay. He was one of my first bosses. He's a famous economist, right? He's the head of the Levy Institute in New York. But Trump gets elected, and instead of having monetary protectionism, now we have trade wars. Trump starts a trade war. Not just with China. He starts right away with aluminum and steel against everybody. And he uses the national security clause to justify that, which means that if there's a national security problem, he can impose this. That's part of a global deal, right? Called safeguards deal. And people are saying, wait a minute, we are your friends. You know, what are you talking about, right? Canada, Brazil, Korea, Japan, these, they're not enemies. Then he takes the US, this is crazy, he takes the US out of an agreement that the US spent years of negotiating, which is the TPP, the Trans-Pacific Partnership, which was set up not only to bypass China and have the US anchored in a very complicated, very dynamic, economically very fast-growing region, which is the Pacific Rim. But it also is an incredible, from the point of view of American capitalist interests, they get a lot of stuff, digital trade, in technology transfer, whatever they want to get. And he said, it's a terrible deal for the US. He has never read anything about it. So he takes the US out. The 11 other countries renegotiate the deal, take out all the stuff that the Americans insisted on to make. You know how good a deal it was by just looking at the difference between the TPP and what is now known as the CPTPP. When you look at the difference, the CPTPP took out all the stuff that the Americans wanted. Not all, but a lot. Okay. But then he abolishes NAFTA, renegotiates it in the USMCA, which is also a complicated story. And then he starts trade wars with Europe. Remember the wine that I talked to you about? Not so easy to find French wines in New York. But then he starts his trade war with China. That's the key. And it's very fast, tit for tat. Within 18 months, the entire trade of China and the US, which is the third largest trade relationship in the world, is tariffed. Then, because it hurts the farmers, right? The Chinese respond by basically cutting off American farm exports, which is very good for Brazil, by the way. Was very good for Brazil at the time. But the farmers are his political base. And so he gives them a lot of money, but they're saying, we don't want money, we want to sell. And so then he says, okay, I have to make a deal with China. I have to stop the war, get them to buy these products, which they do reluctantly. And this is known as the Phase 1 agreement, January 2020. Then he says, okay, but I'm going to do Phase 2 with you guys. If I get reelected, I'm going to hold you to gunpoint by saying, you're going to stop being communist, okay? You're going to stop the way you get technology. You're going to stop subsidizing your industries. You're going to, so there's a whole, this is the moment where I think of myself, wait a minute, I have to start getting serious about variants of capitalism because the Chinese will never do this. Never, right? You get, I was reading very carefully how they were trying to negotiate the negotiations to be Phase 2. And those guys, the guys of the Trump guys were people who hate China, like Peter Navarro, okay? But they don't understand anything about it. And people were saying, listen, those guys that you're sending there, even Lighthizer, they don't understand it. They don't understand institutions, okay? And the Chinese were, okay, great, those guys, those are the guys we're going to talk to, fine. They don't even know when they're going to have an agreement, right? But anyway, that's important because the conflict to be in the future and how this next accumulation regime will put itself in place, whether with or without war, has to do with the US and China, for sure. They are on a path to conflict. And they're in the middle of a path of conflict, okay? And the way the politics work in both places, they need each other as enemies. And so this is pretty terrifying. Because when you look at the history of global conflict, okay, you can look at that again as a pattern. It's always a second power that's frustrated about being a second power and is under pressure as a second power that starts the mess. This is like Austria and Serbia, July 1914, right? Austria is the second power in that coalition, the German coalition, right? And you have the same thing now. Russia is the second power, okay? And it starts trouble because it's under pressure as the second power. So we are kind of drifting into possible world war configuration. Let's be clear about that. That's one of the scenarios, okay? That's why your question about Pelosi's visit is not innocent, right? But the other thing that's more likely is that they're not going to go to war, but they're going to coexist in a very tense way, okay? And they're going to have superpower rivalries across the board. In that moment, Europe is crucial as the third pole. And other regional powers are crucial, like Brazil. You're going to get a multi-polar configuration, not a bipolar configuration. That's the other scenario. And then it's a question of global governance. How do you reform the IMF? How do you reform the United Nations? Who sets up what kind of, because we have institutions now from the dollar standard. They don't work anymore for this period, right? A new institution that I will talk to you about a lot is the Paris Agreement, the climate agreement of 2015. That's a new institution, for better or worse. And that's an institution that's crucial for the transition to the next accumulation regime. But, and okay, I have a few more minutes, right? So you had this process of monetary protectionism. I'm gonna just finish this downswing, okay? Because I want to talk about this crisis and then the upswing to come. So you have monetary protectionism, trade wars, and then you have the pandemic. Okay? Of course, we know the pandemic starts in China. The reasons how and why it starts in China already tell you that pandemics are here to stay. Pandemics are going to be a normal part of our lives. This is what I want you to understand, okay? I don't want you to think that this was just like a once in 100 years event, right? We have created conditions, environmental conditions, through urbanization, rising middle class eating more meat, cutting down the habitat of key animals, especially bats. Okay. Global warming, so they also move around just because of global warming. They change, the habitat gets not only cut down, but also shifted and moved around. We have a much closer relationship to many animals than before. And that is a recipe for pandemics. Right? And so this coronavirus is the fifth in a row. We already had SARS, MERS, Ebola, Zika, avian flu, bird flu, and now this. Okay, all these other, this is the sixth. All the other five, we barely contained them before they become a pandemic. Like now, it's monkeypox. It's still containable. The moment it has one of those variations, that this monkeypox thing could be a variation in the wrong direction. Okay, so that it's not like okay, I didn't make love with her, I don't have monkeypox, you know. No, it has its own spread dynamic, right? So, but this also means something much broader, and which is that we have gotten to a point of an environmental crisis, a systemic environmental crisis, because we also have climate change. This has to do with one aspect of capitalism, which is that it has, rising entropy. We take out low entropy natural resources and we put into the system high entropy waste, and then you get more entropy. Entropy means disorder. This is a fantastic economist who invented this law of entropy, which is a physical law. Okay? It's the second law of thermodynamics, but he put it into the context of economics to found something known as ecological economics. Nikolai Georgescu-Roegen, okay, which is another book you should read, just as being an informed person. Okay? 1971. It's called The Law of Entropy and Economic Crisis, or something like that. Or The Law of Entropy and Economics. But anyway.
Process and the entropy.
Huh?
It's the economic process and the entropy.
Yes, correct.
He was a student, he was a Schumpeter student.
Yes, he was a student of Schumpeter, correct. Absolutely correct. It's true. It's the economic process and the entropy law, yes. Thank you. Huh?
It's an
incredible book.
I read it.
Yeah, I read it too. I read it when I was younger, and I remember that when my son read it, he became an ecological economist.
Yeah.
And not only because of that, but it completely blows you away. And it's written in 1971, okay? Now, the problem is that when you have that process, when you have capitalism being a system of growing entropy, you're going to get an environmental crisis that's systemic, which is exactly what we have now, the beginning of it. You really spend your entire life dealing with this problem. I'm sure of it. This is not a problem that's 2 or 3 years. This is a permanent condition if we let it be. If we don't want to have it as a permanent condition, we need to act fast. We need to build a new economy that stops greenhouse gas emissions. Right? And we're beginning to understand this, okay? We also have to deal with the pandemic and the public healthcare system and how we coordinate, because we have to contain these things fast before we lose control over their spread. So we have to have completely new institutions to deal with these challenges, okay? That's what I'm trying to say, right? And the pandemic began to show a lot of different things that we need to think about, okay? In terms of governance and in terms of public health, but also it revealed very clearly major problems with capitalism. Right? Labor market segmentation. Different workers are exposed to different risks. The inequality. And perversely enough, the way the governments, especially with quantitative easing, right, on top of previous quantitative easing, they juiced the financial markets a lot. So people who are in the financial markets got very rich, even more rich than before. Well, everybody was losing their jobs or being home and figuring out how to survive working from their home. Billionaires were becoming multi-billionaires, basically. Very perverse. So the pandemic is a stress test for society, right? Because it requires governments and people to balance all kinds of things at the same time, which requires a lot of resilience and a lot of communication and a lot of smart thinking, okay? All of which we have a shortage of. But you have a public health challenge, and how you manage it is incredibly important, okay? Different countries have different strategies. That in itself is very interesting. Brazil and US did not do well because it's a very political process, public health, when it's a public health crisis, right? I don't even know whether the Chinese in the end will have handled it well. They have a zero COVID policy that's incredibly brutal, okay? That's at the other extreme of Bolsonaro and Trump. And that's not necessarily a good solution either. But it's a slower problem for them, right? They don't get the herd immunity. And so then when the virus comes in a different configuration, like Omicron, they get completely devastated by it, as they're facing now. Just when we're coming out, they're going into this crisis. But then, because it's a global pandemic, like in 2 months, the world economy went into a coma. Everybody shut down. And then you have both. How do you get out of this, right? Balancing two curves, your epidemic curve and your economic curve, right? You want the epidemic curve to slow down and you want the economic curve to go up. How do you balance that? This is a very big challenge, okay? And they did okay, but it could have done better. And the point is that there's a huge amount of damage. And the damage goes from all the meta level, the highest level of the world economy. There's a lot of damage. There's a lot of broken global supply chains. There's a lot of key players that have been paralyzed. There's a lot of ports that collapsed. So commercial global commerce is under a lot of stress because the ports don't work. There's a lot of much higher levels of debt just to survive. How are you going to deal with that? This is why you have not only an inflation problem, but a stagnation problem, because people have to wind down their debt levels. Okay, so we enter a new period of stagflation. But there's a lot of damage just with people, okay? I mean, you have a lot of guns because people are alone. And people are mentally stressed. So you have a lot of people, mentally stressed people with guns in the US. It makes me nervous, to tell you the truth. I was not nervous in New York for a long, long time. Now I'm nervous. And New York is not so bad as other places. You have a lot of damage in education. You have, like long COVID, you also have long COVID scars in the economy, okay? And we underestimate how much damage there is because we were so terrified by the whole thing that the moment it's a bit less, oh man, I'm back traveling, good, you know? So we have a very difficult transition ahead of us, okay? I'll talk to you about that tomorrow.